Thank you very much, everybody, for joining us for this media briefing where we'll review the third chapter of the annual economic report. And I want to thank Hyun Song-Sun for joining us today. He's the economic advisor and head of research. And I'll hand over to you, Hyun, please, to make some opening remarks. Thank you.
Thank you, Jill, and welcome everyone. Thanks for joining us for the press briefing on Chapter 3 of the BIS Annual Economic Report. So as you've seen, in this chapter we lay out a blueprint for the future monetary system. And we see the system as the fusion of enhanced technical capabilities around the core of the trust embodied in central bank money. Now, it's especially topical because, as we meet today, as you know, the crypto world is in turmoil, and prices have fallen dramatically, and we're seeing the hidden leverage and illiquidity of the crypto ecosystem being put through a severe test, through runs on shadow crypto banks and sharp falls in prices. Now, the sight of crashing prices and runs on crypto shadow banks certainly highlight the risks to financial stability and their potential spillover to the conventional financial system. But they also highlight the gaps in investor protection that need to be addressed. Now, although the turmoil in crypto has grabbed our attention, the deeper structural flaws of crypto, was visible long before. And the bulk of the chapter addresses these deeper structural issues so that we can draw some lessons on the future monetary system. So as you've seen, in our annual economic report chapter published today, we conduct an extensive analysis of the shortcomings of crypto and propose new solutions. And let me give you some highlights of what we present. The first is the fact that stablecoins play such an important role indicate crypto's search for the nominal anchor. As you know, stablecoins are cryptocurrencies that essentially attempt to piggyback on the stability of real money issued by central banks. But the blow-up of the Terra stablecoin has shown that they are often far from stable and are not good units of account. The second important finding is that crypto and stablecoins fail to achieve the full network effects that we normally expect of money. And that's because money is a convention. We all accept money because we expect others to accept it. And now and in the future. And money is the perfect example of the virtuous circle of greater use and greater acceptance. And this maximizes the benefits of the self-reinforcing network effects that are universally available. On the other hand, crypto, in search of its decentralization, achieves exactly the opposite, namely fragmentation. And that's because crypto is settled through consensus among validators, for example, Bitcoin or Ethereum miners. And these validators capture rents for their activities so that the system can continue to run properly. And one way that they do capture rents is through congestion. So when the platform is used intensively, transactions costs and rewards increase. And in a way, congestion is a feature, not a bug. And this is exactly the opposite of the virtuous circle of greater use and greater acceptance. And one way of putting it is to say network effects mean the more the merrier, but crypto achieves exactly the opposite. It's a case of the more the sorrier. So what are we proposing instead? The vision for the future monetary system we lay out in Chapter 3, as mentioned earlier, is the fusion of enhanced technical capabilities around the core of trust provided by central bank money. And money is issued by central banks, the money issued by central banks serves as a unit of account in the economy and it's the means for the ultimate finality of payments by using the central bank's balance sheet itself. And indeed, this settlement function, in fact, predates the monetary policy function for which central banks are better known today. Now, starting from this solid and trusted base, we envisage a superior digital representation of central bank money available to banks and payment providers through wholesale CBDCs, wholesale central bank digital currencies, operating in permissioned distributed ledger technology platforms. And what we argue is that this would enable most of the functionality, most of the functionalities that crypto and stablecoins offer today. For example, the ability to program payments and transfers according to certain conditions, and also to combine different operations into one bundle. Another capability we discuss is tokenization, which is the creation of a digital representation of money or deposits or securities or even real assets such as houses. The metaphor that we introduce for the future monetary system is that of a tree. The solid trunk of the tree is the central bank and central bank money. And the tree supports a rich and vibrant ecosystem of services provided by private sector institutions that build on top. And in this tree, the ecosystem is rooted, figuratively speaking, in the settlement on the central bank's balance sheet itself. Now, if we think of the individual, if an individual monetary system is a tree, then we can zoom out. When we zoom out, we can see the canopy of the forest where the tree branches meet. And the canopy embodies an important additional component of the future monetary system in the form of multi-CBDC platforms, multi-central bank digital currency platforms, in which CBDCs from several central banks can all transact on the same platform, again, using DLT. The chapter explains in detail how this new architecture works and all the many different functionalities. And so to conclude, our broad conclusion is captured in the motto, anything that crypto can do, CBDCs can do better. So they can do this without selling coins to users and without all the other structural flaws that we discussed in the chapter. So Jill, I'd be very happy to take some questions.
Yeah, so we now open to your questions, and I'd encourage you to raise your hand or put your question in the chat. So we'll wait to see if there's any questions. I see 2 raised hands already. I see Daniel Hinge from Central Banking. Daniel, please ask your question.
Hi there. Sorry, can you hear me?
We can, thanks.
Great, perfect. I have a question. How necessary is CBDC for this vision, and could it not be achieved with kind of upgrades to existing payment infrastructure? I just note that there are sort of some costs and risks involved in creating CBDC, and I don't know how practical it is necessarily for all central banks to go down that route.
Thank you, Dan. I think it's fair to say that we can capture a large part of the benefits that come from CBDCs through, for example, retail fast payment systems, which are, if you like, the most developed versions of the 2-tier system, where commercial banks and other payment service providers provide their liabilities for users in providing payment services. What we say in the chapter is that these retail fast payment services and retail CBDCs are actually, they bear a very close family resemblance in that, they're both relying on a registry of users and application programming interfaces, or APIs, that actually enable interoperability between service providers, and that ensures competition and ensures financial inclusion. Now, so that's on the retail side. So before we get to the wholesale side, when we typically hear the debates about the desirability of CBDCs or the potential risks, we hear two types of arguments. So one argument says, oh, CBDCs, even if they are available, they won't be used enough. So they won't be popular enough and won't be used by everyday users. The other type of argument goes to the polar opposite and says, oh, these retail CBDCs will be too popular. And because they're too popular, they could actually disintermediate the banking sector and take away deposits and so on. And I think the truth is definitely somewhere in between, in that I think neither of these arguments are all that convincing. And how do we know that? Well, I think in those instances when the retail fast payment systems have been rolled out, what we find is that as these systems take off, and one very good example is the PIX system in Brazil, which has signed up 2/3 of the adult population in Brazil in about a year after its launch in November 2020. As the use actually it rises very, very fast, what you see is that banking services, the demand for banking services also go up. So one of the charts that we show in the chapter is that credit and debit card payments actually, rather than being crowded out by the PIX payment system, actually rises in tandem, because what turns out is that as users are brought into the system, they actually demand more of the banking services that are bundled with credit as well. So in fact, I think the truth is and I think it's a very reasonable case to make that for retail CBDCs and their close cousins, which are the retail fast payment services, they actually enable financial inclusion and actually create new business lines for financial intermediaries, so that in fact the system becomes more vibrant, and there is a greater degree of services that are available. On the wholesale side, so wholesale CBDCs are CBDCs that are available to commercial banks and for payment service providers. I think in that case, the focus is very much on financing for trade, financing for working capital for companies. These are much larger transactions that go through the system. These are wholesale. And there, especially when we have the so-called multi-CBDC platforms that bring more than one currency to the platform, it's typically operated in a decentralized way, and that's because there's more than one central bank involved, and therefore, for governance reasons, it's just much better to have a decentralized setting. And that really cannot be replicated with a centralized system that we have. And I think, as we know, the current arrangement, which has to do with banks that maintain deposits in their correspondent banking with their correspondent banks in all parts of the world, is a very inefficient and very costly way of conducting business, and these MCBDC platforms would provide a great leap in terms of efficiency.
Thanks very much, Yun. And if you wanted to look on page 102 as well, we list some of the data on different kind of projects that are underway in the central banking community and beyond on CBDC, retail fast payments, and wholesale CBDC. The next question, I think it's James McIntosh from the Wall Street Journal. James, if you want to unmute and ask your question, please.
Hopefully you can hear me.
Yep.
Excellent. Hyun, I had two questions. The first was just given what's going on in crypto at the moment, you mentioned spillover effects. Do you think there could be spillover effects into the real economy, or perhaps even worse, into the real financial system from the traditional financial system, let's say, rather than real, from the current crypto crash? And then the second question, in your vision of the future, do you worry about sort of privacy issues, the far greater potential for government intrusion into individual lives, I mean, obvious use cases from a government perspective that individuals might not want are to restrict how people can use certain money that they're given by the government, benefit type payments, to prevent people spending it necessarily as they wish, or sanctions enforcement sanctions could be far more frequently used if you can just program it into the base money, and whether that bothers you and whether you see any potential to prevent it, or if you just welcome it.
Thank you, James. Let me go to your first question, which is about spillovers. I think what we've seen in the last few weeks is that some of the mechanisms, some of the economic, if you like, the microeconomic mechanisms that we saw, in past financial stress episodes in the conventional financial system, have also been playing out in the crypto world. For example, interconnectedness, leverage that's being unwound, and you're very familiar with these things. Of course, the maturity mismatch. So in terms of the microeconomic mechanisms, they're all familiar ones. It's just that they're playing out in the crypto world. Now, of course, in terms of the scale, it's nothing like the GFC, which was really about mortgages and the banking sector, which is really the core of the financial system. So that had a much bigger macroeconomic impact. I think it would be fair to say that even now, the crypto world is relatively self-contained. But I think the issues that we will need to watch out for are who are the players that are straddling both the crypto world and the conventional financial system. And it could be that if a shock were there in the crypto world, that would affect the behavior and therefore the actions of some players, which may have repercussions beyond. We don't know exactly what those channels are yet, not in as great a detail as in the conventional financial sector. But I think the short answer to your question is the mechanisms are similar, but the scale is much smaller. On your second question about privacy, I mean, that's a very, very important point. And it's, of course, as we said in last year's annual economic report chapter, data privacy has attributes of a basic right. And so this is something that we need to keep at the front of our minds when we formulate policy on this. Now, the way that we take care of it currently is through stringent rules on data privacy. So, on data privacy. So, for example, even now, the commercial banks, the credit card companies, they have a lot of transactions information, and there is a lot of personal data that they are actually, the custodians of. And so banks and credit card companies, they're really subject to quite stringent regulation that ensure that the data is kept private and there are no breaches. So when we think about the future, and what do we what can we do to actually preserve data privacy in that future system? Well, I think it has to be a case the same type of rigorous regulations that are applied now are also applied, for that future system. Now, some of it, would apply to central banks, because if central banks are actually operating the ledger, then the same kind of stringent regulations that apply to commercial banks now would need to be applied to central banks. And central banks, even as a public institution, will be subject to very stringent stringent regulation in that respect. And in fact, this is more an issue that we addressed last year in our chapter on CBDCs. We lay out this principle called the jigsaw puzzle principle, which is that when we have data privacy being a very important policy concern, we should make sure that whether it be a private institution or a public institution, each institution should only be, should only have access to the absolute minimum amount of data and information, for them to actually perform their tasks. and no more. And it's really only the individual, him or herself, that actually has the full picture. So everyone has a piece of the jigsaw puzzle, but not the whole, picture. And I think that principle would need to be rigorously enforced. So I think the short answer to your question, James, is we just have to do what we're doing today, but to apply it in perhaps different contexts.
Thanks very much, Jan and James, for your question. The next question comes from Carolyn Look from Bloomberg. Carolyn, if you want to ask your question.
Thanks for taking my questions. I just have two, and that is basically I'd like to know what makes you so confident that CBDCs will actually catch on among consumers, especially those consumers who are interested in cryptos, because they're presumably interested in cryptos for a very different reason than people might be interested in CBDCs in the long run. And secondly, I'm wondering how much of a risk there is that central banks will end up wasting quite a substantial amount of time and resources on creating these CBDCs. And, in those jurisdictions where they've already started launching them, they've been rather slow to take off. And I'm just wondering, whether you have any doubts about how noticeable they will actually be to consumers in the long run. Thanks.
Thank you, Carolyn. So let me take your first question, which is about, I think you were referring to retail CBDCs and whether retail CBDCs would actually catch on. I would just reiterate what I said on the family resemblance between retail fast payment systems like the BIS system in Brazil and retail CBDCs. The BIS rollout in November 2020 was really, quite an important event in, if you like, monetary theory, monetary policy. The next step in the study of monetary economics, in that we had a system which was launched during the pandemic. It caught on pretty quickly, signing up 2/3 of the adult population within 1 year. That is quite a remarkable achievement. Now, what we say in the chapter, and we explain this in quite some detail, is that there is a great deal of family resemblance between a retail fast payment system like BIS and retail CBDCs, in that they both rely on a registry of a registry of users, if you like, a digital ID registry, if you like, together with APIs that actually ensure interoperability between banking services, other non-bank payment providers, that actually ensure that the services and the wallets that each of these providers provide to users actually communicate with each other. And that means that customers of one bank and customers of another bank, they can send money to each other instantly. And that's because there is a central registry where there are there's a list of users. You can immediately see where that payment needs to be routed. The only difference is that with a CBDC, this is a direct claim on the central bank. Now, what would happen with a retail CBDC is that rather than sending retail balances through deposits of the commercial bank, the commercial banks would be operating wallets, and it's the tokens that are just going to be transmitted. Now, that's the only difference, and in fact, most of the benefits you could argue are already captured with a retail fast payment system. So I think when we look at the way that several economies have actually, several countries have brought in retail fast payment systems, you can already foresee that the take-up would be pretty rapid. And I think a very telling example is actually what India has decided. India has one of the best retail fast payment systems in the world. It's called UPI. And it's led the way in seeing how these, in actually showing the way on how these systems would actually operate. But India has decided to go the final step and actually roll out a retail CBDC. That announcement came earlier this year, and because it's only a marginal, a marginal upgrade from the retail fast payment system to the CBDC, there is not a huge leap in terms of the platform there. So I think we can exaggerate the additional incremental investment you would need. I guess your second question was about the waste of resources. Oh, I guess I've just answered that actually, and in terms of my response to the India case. Let me know if I haven't answered your question.
Okay, great. Okay, we'll take that as a yes. And Natalie Olaf-Urs from Agence France Presse has a question.
Thanks for taking my question. My question is on the timeline. It takes just a few clicks to create a cryptocurrency, but putting in place a full-scale trusted CBDC takes a lot longer. So could you explain us what challenges the central banks will have to overcome, and what kind of time horizon are we looking at before we can think of a fully operational CBDC environment?
Thank you, Natalie. I think that's a very good question. Let me try and break that down into several components. Already you can argue. You could argue that central bank reserves that are part of the wholesale payment system, that are part of these real-time gross settlement systems, they're a form of CBDCs already. And so on the wholesale front, there have been experiments that have been conducted now for about 10 years. Bank of Canada was one, way back in 2012. Monetary Authority of Singapore. And in the chapter, what we do is we lay out several examples of the more recent multi-CBDC arrangements. So on the wholesale side, it's going to be relatively easier to just build on the current RTGS system, and there'll be, if you like, fewer steps needed. But still, it's one thing to say that these trials have been successful, these experiments have been successful. I think what we will need to do is to have trials at in scale that actually can demonstrate the kind of resilience and the performance that can be really take real world use properly, and that will take some time. It's I can't give you an exact number of years, but it'll be more than 2 or 3 years before we can have something like that. But I think a very important point to make is that we should, in any case, and this is one of the sort of conclusions that we draw, because of the time involved, the time to start is actually now. And we should be formulating these plans in anticipation of developments rather than sort of reacting. And so in a way, it's it's a plea to have this more forward-looking approach. On the retail side, I think the rollout of retail fast payment systems, that is a very, very important and promising and encouraging development, if you like. And they, if you like, they can be seen as precursors to full-blown retail CBDCs. Not all economies would actually go to the full-blown retail CBDCs. You can capture the bulk of the benefits with just the retail fast payment systems, but of course some economies will go the full way. But that again will take some time.
Thank you. I hope that answers your question. I think Martin Arnold has a raised hand, please, as well. Over to you. think we can hear you unmuting, Martin, but we don't hear you yet. We'll give you a moment.
There
you are, yeah. Okay, work away.
You can hear me?
Yeah.
Great, yeah, fantastic. So my question is on cross-border payments, and you talked about the inefficiency of banks maintaining deposits with correspondent banks around the world and how inefficient this is. But how easy would it be for to set up some kind of a platform for exchange of CBDs, different CBDCs? Is that something that you've looked at in this report? How easy would that be? And my second question is, do you imagine, just in terms of the differentiation between wholesale CBDCs and retail CBDCs, do you think that there'll be that wholesale CBDCs will launch first and then retail ones will come later because they're perhaps more difficult or complicated? Thank you.
Thank you, Martin. The answer to your first question, so your first question was on multi-CBDC platforms. Does the chapter examine the operation of these multi-CBDC platforms? The answer is yes. And in fact, we actually draw on on a number of trials actually that's going on in the BIS Innovation Hub in partnership with our member central banks. So just to mention two, there's one that is run out of the Hong Kong Center of the Innovation Hub that's called Project MBridge. So M being the multi-CBDC platform and bridge, in the sense of bridging. Then there's another experiment run out of a Singapore center that's called Project Dunbar, and each one of them has the BIS together with 4 other central banks that are forming these common platforms. And the way that these platforms work is to use distributed ledger technology, but using real names. So what we do is, clearly, if you don't have, as in crypto, this device of hiding behind the private key, you have to use real names. And if you use real names, you cannot simply post all the transactions for everyone to see because that would violate privacy. So the way that these DLT platforms work is that there is a distributed ledger technology where you can prove that the token you're transferring is genuine, that you actually have the funds. And you can do it by proving the provenance, if you like, the origin of your token by using cryptographic techniques like zero-knowledge proofs to show that it actually derives from a valid history of past transactions without revealing what exactly the transactions are. So, it's a very constructive use of cryptography. And using that, what you can do is you can just, you can form smart contracts, you can transfer, you can bundle them so that you have, atomic settlement where the house is transferred if and only if the money is transferred. So you don't need an escrow account and so on. So what this type of system enables you to do is to avoid the current practice, which is to say, if I want to make a payment to a, on behalf of my client to a supplier, on another continent, what you need to do is to hold a deposit in a bank in that jurisdiction, ideally, and then just call up the bank and say, look, debit my account and credit the account of the supplier. And if you don't have an account, you have to use a correspondent bank. And if you don't even have a correspondent bank with a deposit in that jurisdiction, you need to string along a whole host of different correspondent banks. Now, for that system to work, you need to hold balances at all of these different parts of the chain. And in a way, it's going back to the origins of supply chain financing, where the credit function and the payment function all are bundled together. And so it's incredibly intensive in terms of liquidity, and there are the operational challenges all along the chain. What this kind of platform can do is to just short circuit all of that And of course, what you would need to do is, of course, convert some of your deposits into tokens. Yeah. So you cannot avoid tying up some of your deposits somewhere, but you can just do it once, and let's say just hold it in London, and then the tokens can circulate everywhere. Without having to, lock up liquidity at different points, around the world. Together with all the other problems that go along with that. Now, how far are we from seeing these things in action? Well, we've done experiments and they work. What we need to do is to make sure that we can actually build this to scale and build it so that they have the resilience that will really, stand the test of, real-world use. But the technology is pretty clear, and this is not experimental technology. Public key cryptography is when you go onto your web browser. It's you can see when you're paying with your credit card that you have a secure connection. That's exactly the same type of public key cryptography that we're using with these payments. On your second question, wholesale and retail, which will come first? I think what we're seeing is that they are moving together. There are some jurisdictions like China, which have already, they're already in trials of their retail CBDC, the ECNY, and they're in the trial stage. So, so it's well past experimental stage. It's actually now in trials. On the wholesale side, if you look at the chapter, there are these experiments we're doing in our innovation hub centers, but it's I think fair to say that we are now sufficiently familiar with some of the workings of this that we can think about moving to, if you like, sort of building the prototypes and other things that we can actually use in real life. Jill.
Thanks very much. Hope that answers your question, Martin. I'm looking now at the screen and I'm not seeing any other hands raised or questions in the text. There's also press@bis.org. I don't think we've had any other questions there. So I think I see James with his hand raised again. James McIntosh, if that's you, you have the floor.
Hi, yeah, Hyun, it was just a sort of follow up to my previous one.
Sure.
on privacy. I understand about the yes, all right, banks are currently able to stay private. I was interested as much in the programmability, which is a new power really. There's a small extent to which, at the moment, governments can, with quite a lot of hassle, enforce things like sanctions on the banking system. But programmability allows them to go much further and to use it much more widely. I mean, sanctions can just be built in instantly if they so wish on almost anything or anybody, and also on how money is paid. So if you want to give someone food vouchers they can only use on food, at the moment it requires in the US a whole separate administrative structure, effectively a whole separate form of money with a great expense. It would be very easy to do a thing that says, well, these benefit payments can't be used for alcohol, tobacco or gambling or whatever other thing the government decides is politically a nice thing to impose on people, or indeed that you can't, if you're imposing restrictions on people's movement, that you can't use it for train tickets, or if you're in China that you can't use it for all sorts of things that they regard as bad unless you are an upstanding citizen, these sorts of things. Are you bothered about this sort of when I talk about intrusion, this seems to me much more intrusive than current issues around privacy.
So, James, I think you're referring to the retail CBDCs rather than wholesale.
Yes. Yeah.
Okay.
Yeah.
Okay. Because I think for wholesale, the programmability applications are quite well known. It's payment versus delivery, payment versus payment, these kinds of things where you can actually bundle transactions. I think you're talking much more about programmability of retail CBDCs, which restricts the use to specific contexts.
Yes.
Okay, so let me address that. So I think it's worth actually just thinking about how how programmability could have been used during the pandemic. So one of the things that we certainly found was that when the fiscal disbursements needed to happen in the early stages, so there was some economies went into shutdown, the economy was grinding to a halt. You needed to get the resources to people right away. The big dividing line wasn't between those economies with CBDCs and those without, and indeed not many economies actually have CBDCs right now even. The difference really was how efficient was your banking system, and how inclusive was your banking system, in that most of the citizens, most of the residents actually had a bank account. So in those economies where the financial system was pretty inclusive and pretty much everyone had a bank account, as soon as you made the political decision to go ahead with the disbursement itself was very, very quick. What really took a lot of time was the deliberations, in particular the political deliberations that actually led to that point. Now, once you made the decision, it was passed in Parliament. The actual disbursement was really very, very quick. And those economies that actually had inclusive banking systems, where everyone pretty much had an account, if indeed you had a retail fast payment system, then you had the money basically on your app, on your phone right away. It was really the other economies that didn't have that, and some countries actually had to mail checks, paper checks, through the post. And then you would get the post in a few days, and then you then deposit in your bank, then another few days, then the check would clear, and then you can spend your money. So I think that was the big divide. Do you actually have have an inclusive payment system that actually does that? In terms of programmability, let me give you an example of what happened in Korea, which was, I think, one of those cases, which did have a pretty inclusive banking system. These disbursements happened right away. You can do programmability even with, retail fast payment systems, and so the disbursements were actually tied to your address, so that the disbursements were actually encouraged to be used with your local merchants. This was the idea that rather than going to e-commerce, you would actually go and spend the money in your local shop. So programmability isn't just about CBDCs as such. It's as long as you have the APIs that I mentioned, and this is why the retail fast payment system and CBDCs are so similar. You can do most of that, in any case. But having said all of this, I think that was a very much an exceptional case. Having said all of this, I think it's a bit of an oxymoron to say that it's a bit of an oxymoron to talk about programmable money. Programmable money is not really money. It's we should think of that as vouchers rather than money, because money is something that's almost by definition state independent. It's something that doesn't depend on the state of the world. This is why money is such has this incredible property of the network effect, that you don't need to worry about the state of the world or the time. It's money is money. And so yes, we can do we can think of these very clever things. First point is that it's not exclusive to CBDCs. As long as you have the APIs and the digital IDs, you can still do it with a current payment system. But having said all of that, money is money. We shouldn't really confuse it with vouchers.
Thanks very much. I'll see if there are any other questions. I think there are none. I'll just wait for a moment just to check if there are anything else. While no hands are raised, just to kind of cover off the housekeeping, this is embargoed. The embargo lifts tomorrow. That's Tuesday, 21st of June, at 1 o'clock, if I'm correct. And just watching to see if there's any more hands or questions. I don't think there is. Thank you very much for joining us today. As you know, this is a two-part press briefing. We'll have another briefing on the remainder of the annual economic report on Thursday. So look forward to seeing most of you again then. And we're at hand to answer any further questions or follow-up you may have. So take care.